Hey guys, it's Dave with another update. We had some information come out this week. The JOLTS report, which is the job openings and labor tracking survey, came in hotter than expected. We had 10.1 million job openings. They were only estimating 9.5 million, and that reverses a trend of job openings coming down. We wanted to see job openings come down, not because necessarily they're getting filled, but because we want to see the overall economy start to cool, and therefore businesses want to hire less and eliminate the job openings. This is viewed as deflationary, or at least against inflation. And that's what we want to see in order to get the Fed to stop raising these interest rates. But this bit of information kind of throws water on that. If the economy is going faster than we want it to, then the Fed will continue to raise rates until it slows down. So this bit of information, not great for us if you're in my camp wanting interest rates to come back down so that home prices are a little more affordable. At the same time, we also got a pricing index for U.S. manufacturers, and that came in strong as well. And what this is the cost of goods, or the price that manufacturers pay for the parts that they use to assemble and manufacture things in the U.S. It came in at 53.2. They were forecasting 49.0. This is also not good information if you want interest rates to come down. What this means is they're paying more for the goods to make your iPhone or make whatever it is that they're manufacturing, and they have a tendency to pass those costs along to you, which is inflationary. And right now we don't need any more inflation. This week has been kind of crazy with the way people are forecasting what the Fed is going to do with their interest rate hikes. We have currently showing a 65.7% chance that the Fed will hold rates at the next meeting. This is going back and forth. If you look at this line here, last week we had a probability of 67 that we would hold, but then yesterday it was only a 37% chance, and there was a 63% chance that the market was forecasting the Fed would raise rates by 0.25% in the next meeting. There's also a good chance, a 49% chance, that it would happen in the following meeting on July 29th, and possibly a second one if they did one in June, but also one in July, a 16% chance of that. So the market is really kind of going back and forth as data comes in. They adjust what they think is the Fed is going to do. The Fed talks. They have the different Fed members give speeches and things like that. They're trying to get information to get any kind of hint that they can of what the Fed is going to do with interest rates. So right now, forecasting, about 2/3 of people are thinking we're going to stay put, but now we're up to a 34% chance that they're going to raise interest rates. Mortgage rates have continued to stay up around 7% this week. Now, that's the overall index. As I've mentioned before, I think you could probably get about a 0.5% lower than that, depending on your credit score, down payment, things of that nature. But anytime we hit back and bump up against that 7% range, I start to see traffic drop a little bit in the showings and just the overall buzz and activity that we have in the housing market. So just interesting to see what all of this data is doing to mortgage rates, to the Treasury notes. They're bouncing around, pushing up to 4% on the 10-year Treasury. Let's take a look at kind of the housing data. We're still showing low volume compared to previous years. This is the Redfin housing data. This is for the number of homes sold in all metros. You'll see that because of this drop in red, this is 2020. So here's when the pandemic hit and the overall volume of homes sold dropped. We're higher than that now, but still well below the last 2 years. This is homes sold. So this speaks to closings and activity, not to price. If I click over on median sale price, you'll see that we're actually ticking back up overall. This is the overall all metros, to only being down 2% over last year. We still have a few markets like Boise and Austin that are down double digits, like 10, 15%. But we also have markets like Miami that are holding pretty well. Nashville's holding well. And then a few markets that are in, down the low single digits that kind of help balance out this -2. This is a bit of a, bubble, if you will, for last summer, and we'll just see if this continues to decline. My guess is with interest rates hitting 7, you'll see this start to flatten out and not eclipse this overall unless we get a drop in interest rates. But so far, we're recovering a lot of the losses that we had at the end of last year, and even higher now than we were at the end of last year in terms of the overall median sale price. And as far as jobs and the recession goes, is the recession coming? We don't really know, but looking at this JOLTS report, bringing it back to the 10.1 million job openings that we have, this means that companies are hiring. And I have this chart here that kind of shows historical data. This is, I'll give a shout out to Shivako Capital on Twitter. Chris Shivako does a lot of good charts. He does a weekly YouTube video. You should check out his YouTube channel. This is the unemployment rate going back to 1987. And the areas here in gray are recessions. So this would be a recession back in the early 90s. You can see the unemployment rate start to tick up, and then we have a recession. We have the same kind of thing happen here in 2000. We have the unemployment rate start to tick up. We have a recession. We have the same thing happen. This is the Great Recession. You see the bigger gap of gray. We were in a recession longer here, but again, we had a bottoming of the unemployment rate, and then unemployment starts to tick up. That means the percentage of people that are employed is getting smaller. The number of unemployed people is going up. And then we have this big recession. Then it peaks here. This line is almost 10%. So it got really bad at the peak of the last Great Recession. We have this weird little spike for COVID, but as you can see at the end of the chart here, we're not trending up. We're still trending down. And that's really what this kind of boils down to in terms of this flip-flopping of, are we going to raise rates? Are we getting into a recession? The Fed has got two mandates. It is maximum employment and inflation under control. And so right now we have maximum employment, but at the cost of inflation. If the CPI comes in pretty high on June 13th, we're definitely going to get another rate hike. This goes against everything we thought we knew 2 weeks ago when we had a 98% probability that they were going to take a pause. We just can't seem to shake the inflation, and we just can't seem to have an economy that doesn't have maximum employment. It's very strange to root against the economy to save the economy. We want less people buying and less people competing for prices to keep those prices coming down. In order to do that, we need a few people less that are employed, or at least the warning signs or the payments that their credit cards and their student loans have to put a little more pressure on them to not spend exorbitantly in the economy, and hopefully that will tame inflation. But that's what I got for you today, keeping an eye on real estate and the markets. Why don't you like this video while you're here? Thanks for watching it all the way to the end. I really appreciate that, and I'll see you on the next one. Thanks.